G'day, ladies and gentlemen, expats. Welcome to another episode of Expat Chat, episode 157 today. As always, I'm joined with my mate, colleague, mentor, all the above, Brett Evans. How are you, mate?
All well, thanks. All well. We're, sort of racing into Christmas. My daughter reminded me the other day how many days it is to Christmas. Not that she knows, but she knows too much. Made all good here. The fogs are coming in, which means summer's coming to an end. So it's a pain to
Oh
drive
no.
because no one here can drive on the best of days, let alone during fog. But it means summer's coming to an end and happy days there. So and to the folks on the call,
Yeah.
if you're new to us, g'day. And joined with my mate and colleague and managing director for the APAC region, Mr. James Ridley.
And that's actually something I missed. The founding director for the Atlas Wealth Group, Brett Evans, currently the managing director for the Europe, Middle East and Africa's region. We've got a good topic today, talking about family trusts or Australian discretionary trusts. They are, I suppose, Australian family trusts, and I guess why you don't need one when you're a non-resident. What I guess we'll go into a little bit of probably good use cases as well, but also probably bad use cases as well. But let's keep those compliance lawyers happy. Over to you, Brett.
Mate, all the information we're going to share with the good folks today should be treated as informational and educational purposes only. Please do not construe this as personal advice. And if you do need personal advice, reach out to a specialist like Atlas.
Absolutely, mate. Now, jumping into it, family trusts or discretionary trusts in Australia, they are probably the most common used tax vehicle or tax entity in Australia, especially for, I suppose, families with significant wealth or that are building significant wealth. And the most common theme is that those families are actually in Australia. They are Australian tax residents. And they are a terrific tool because they allow you to accumulate assets within that trust. But I guess the main purpose is the ability to have the discretion, yeah, thus the discretionary part, discretion to deem income and capital gains to an individual that has ideally the lowest marginal tax rate in the family. Now, a discretionary trust or a family trust, I'm just going to refer to them going forward as a family trust, is governed by what's called a trust deed. Now, there's a few things that we can put in trust deeds, but that helps us determine who we can actually distribute income to, who can be a beneficiary of the trust. The most common in Australia is what we call a bloodline trust deed, and that means that anyone that's related to us, if it's a myself and my partner, anyone that's related to us from a bloodline aspect, we can distribute income or capital gains to, and it can also be related entities as well. So they provide a great tool in Australia to reduce our income taxes and build wealth in a really tax effective way. The other real attractive component of a family trust is how long they can last for. Now in Australia, trust deeds are actually drawn up from where they originate based on the state or territory. The most common maturity date or principal date in terms of time frame is 80 years. So that's typically longer than our superannuation funds. Um, it, it would be. But with that in mind, that's why they are a terrific tool for building intergenerational wealth because they can last for 80 years. And then after 80 years, any assets need to mature and potentially be distributed either to individuals or there needs to be another trust deed that's formed or another entity in which they are distributed to, such as a bucket company. I've said a lot, so I'm gonna take a breath here and pass it over to Brett to just give us a bit of insight when it comes to non-residents.
And I couldn't say it better myself. So I think we're done for the day. Thanks very much, folks. Goodbye.
Wash our hands of that one.
When you said who it's useful for, I thought you meant to make a comment about Brittany Higgins and how it's also good to protect your assets as well too. So that's a bit topical at the moment, what's happening there. But look, I think,
Isn't it?
these structures get sold on certainly the tax bent. They get sold on the asset protection bent.
Yep.
Just to sort of explain it in plain English, how virtually what you've eloquently explained in sort of a numerical fashion. Imagine you have, four beneficiaries, husband, wife, and two kids, and that trust is going to push out $100 dividend or an income. Obviously, if that was going to one person, that person would be paying marginal tax rates on their assessable income. Whereas when you disseminate it to four beneficiaries, then if it's equally divided amongst all four, suddenly now everyone's in tax on $25 instead of $100. So that's
Yeah.
just you just wanted to give that a bit of a layman's explanation as to why people do use it. The biggest problem with trusts for expats is a trust is deemed as a tax resident. It's actually a person in Australia. So this can and can sometimes does and doesn't work for you as an expat. So let's say, for example, as folks know, when you leave the country, you will have assets splitting into taxable and non-taxable assets. So taxable assets, house, apartment, block of land; non-taxable assets, shares, managed funds, and ETFs. Time and again, we're seeing people who have shares, non-taxable assets, what would be classified as non-taxable assets, sitting inside of a family trust. The problem with that is, even though you're a non-resident, and if you held those in your name or joint names with your partner or spouse, you don't actually get the benefit of zero capital gains tax accrual because it's held by the trust, and the trust is an Australian tax resident. So there has to be that sort of declaring process that you need to pull out as you're leaving the country, depending on what assets you hold in the trust. Conversely, trusts actually work well if you're holding Australian property as a non-resident, because as folks on the call know, if you hold a property as a non-resident in your own name, you do not get the 50% capital gains discount. Whereas as a trust in Australia as a tax resident, you do. So there are pros and cons as to why you would hold a property in a trust, why you would hold shares in a trust, and the do's and the don'ts with that. But I think a lot of folks, it is hard, not hard, it's more difficult to get a loan to buy a property in a trust as a non-resident than it is to get a loan as a joint subordinate. See a lot of that going on. So primarily what we see is folks holding assets like shares in a trust, which are okay from, as James said, from a legacy point of view. You can build a structure that you can pass assets on to your children in an intergenerational way without crystallizing the gains, because you just remove yourself as the beneficiary and your kids take over as the beneficiary. So it's sort of that conga line that continues. But there is a time and a place to use a trust. And while as a non-resident living overseas, especially if you're in a place like the Middle East where there's no capital gains tax, or Switzerland or Singapore or Hong Kong, you want to be maximizing that wealth creation in your individual name. So it sounds funny how in Australia you want things in super and trusts and companies and bucket companies, whereas when you become an expat, you actually don't want any of those structures if you're holding a share portfolio. But when you're moving back to Australia, as we know, you have deemed acquisition. You acquire the shares at the price on your date of arrival when you hit that passenger arrival card saying, yep, I'm a resident returning. Then you can always move it into a trust. And we did it all the time for clients. If they want to create a legacy asset that enables them to build and grow with their family, then trusts are a fantastic thing. But, like we always say, you need to demarcate your strategy and your advice based on your residency. So while you're resident, do X. While you're non-resident, do Y. When you return, go back to doing X again. Don't be lazy and say, I'll just leave it in the trust. If you like to give money to the ATO, then give it to me. I'll spend it a lot far, more efficiently than the ATO will, or the Australian government will, through their consolidated revenues. But to me, just especially overseas for 3 to 5 years, that's 3 to 5 years of unencumbered growth. And that's a big thing.
Yeah, absolutely. And I think there's a time and a place, and often when we have clients repatriating and they've grown their assets, whether property, shares, super, tax structuring is a big part of that. Okay, well, how do we preserve the wealth that you've built in the right and, I suppose, tax structure in a tax efficient way? What's the next step on that as well? And that's when the trust conversation can come about. And depending on our household, that's when we consider what we call bucket companies or corporate beneficiaries. I get really excited about that kind of tax planning because that's the old accountant in me becoming a bit of a nerd. I love the fact that you can have a tax stopgap at 30% for the household, regardless of what you're doing. That's great. Love it. So with that in mind, I think just bear in mind that, yep, a lot of people talk about having a family trust, discretionary trust. They all, it's a bit of a buzzword, isn't it?
It
Oh,
sounds
that's
cool.
cool.
No, it sounds
It
cool.
sounds cool. Oh, geez, you must be worth a lot. Got a family trust. Holy
Exactly. Yeah.
shit. Look
Yeah.
at you.
Yeah.
God, look at you go. So be mindful of how and when they should be used because they can cause detriment to your situation if you're using them incorrectly, especially while you're residing overseas. And we've seen it time and time again, plenty of tax determinations. There was two big ones reported in 2022 where if they held it correctly, the assets in the right structure, they wouldn't have had to pay hundreds of thousands of dollars in capital gains tax to the ATO. So just be careful.
I think also too, folks don't realise that for a trust to be compliant, if you do want to retain holding a trust while overseas, you need to have a trustee on there who's also an Australian tax resident. So you can still be a trustee, and if you've got a partner or a spouse, they can be a trustee as well. But you actually need someone back in Oz also as a trustee as well. So essentially it goes from 2 to 3 or 1 to 2, depending on what structure you have. But the biggest thing, to make sure you do is keep it compliant. So a lot of
Yep.
folks don't understand the tax reporting requirements and all those sort of scenarios. They continue while you're overseas. As I said, you can design and build quite a fluent, strategy around trusts, but don't be lazy. That's where I see a lot of the problems that people get into. They go, I just can't be bothered winding it up, and maybe do that, maybe do this, do it, because the sooner you get the money out of there, yes, there might be capital gains tax that you got to pay, but if your time overseas is, a reasonable time, 3 to 5, maybe 10
Mm.
years, that's
Mm.
3 to 5 to 10 years unencumbered, with no liability from a capital gains tax point of view. It's worth the effort, it's worth the pain to wind it up or strip it out and just, sort of leave it on the shelf. It's up to you. But at the end of the day, you do need to take that into account. The last point I wanted to make was if we do see the proposed modernising tax residency rules go through by the Board of Taxation, the catch for that is under the economic factor test is being beneficiary of a trust. So you may not own any property in Australia. You might be thinking, I can breach the so-called 45 days. Great. But guess
Mm.
what? If you're a beneficiary of a trust, whether it's yours or your parents, you need to have that conversation because we obviously we
Yeah.
don't know what's going to happen yet with Canberra. He's busy running around lighting up the Burj Khalifa with a flag. Recently here this week in the UAE and
He's,
talking how Vegemite and shapes are cheaper to buy in UAE than they are back in Australia, which still boggles the mind. But that to me is the big thing is you need to take into consideration is a good strategy. If you want to get blood from a stone, you need to put a bit of effort into it. And by putting effort into it, look at these scenarios and look at these cases where what should you do or can you do just to optimize that extra piece? Because it's funny how people go, oh no, I'll do it. And then suddenly 3 years go by. And that's 3 years where the capital gains tax liability have accrued and the ATL will ask for that, you wouldn't have to pay otherwise.
yeah, absolutely. So buyer beware, do your research, engage a professional to get the right advice if you're considering that kind of tax structure. Absolutely. A bit of housekeeping. If you haven't joined our Facebook group, the Australian Expat Financial Forum, highly recommend you do some great things in there. Love seeing all the questions and love seeing all the responses from the other Australians in the group, providing support, answering, I suppose, a lot of questions that they've already solved. It's great to see. Often if you throw a question in there, you're, on average, I'm seeing anywhere from 3 to 20 people jump on and comment. So
Yeah.
you're getting a lot of feedback from other Australians. We try and moderate where possible, kick out any, I suppose, dodgy people, any spam people or anything like that. We haven't had to do that, to be honest. So that's been good. But yes, if you're not in there, get in there. Some great things happening in that group.
Definitely. And also too, later this month, we will have our Australian Expat Masterclass in both Dubai and Abu Dhabi. So Adam and I will be on the road again, following on from that very successful one we had in Doha
Yeah.
last month. So if you do want to learn about tax, mortgages, financial planning, asset management, being an expat, living in the Middle East, come along to those events. There's no charge. We give you a beer or wine, a bit of food. It helps you focus on the boring topics of finance and tax. But make sure you get along. If you go to our website, go to the events page, you'll see all the details there. So definitely come along and I'll shout you a beer.
Sounds good, mate. Might have to do it myself, to be honest. Get over
Yeah,
to those events.
get over, mate. Come over. We'd love to have you.
All right. Well, thanks for another episode, guys. See you on the next episode. Thanks, Brett.
Cheers, James. Talk to you soon.